G'day folks, and welcome back to this weekend update for February 13. So the last couple of days in the US we've had attempted sell-offs early in the session, only to close on the highs of the day, and that's happened again on Friday night. So we saw a bit of a sell-off in the Australian market on Friday, particularly in the last half hour. Most stocks were sold down, and I think that was probably due to some nervousness over what was happening in Egypt. But now that situation seems to have resolved itself, and the US markets were strongly higher, and I would expect that we will rebound on Monday morning. So let's get to have a look at some of the key things that happened on Saturday morning, and then to the charts. So this is the important information with regard to licensing and the nature of the information. So just a bit of a quick summary. The S&P 500 is still strong, closed on its absolute highs yet again on Saturday morning at 1329, and I'm really finding it hard looking at things both from a technical perspective and a fundamental perspective to find what could really derail the market this year in a serious way. Now, we will get corrections along the way, that's an absolute given, but I really can't see anything that might cause a 15 to 20% correction in the market. I can see normal market forces when the market gets a bit overvalued. I can see 5 and 10%, but it's pretty hard to see what's going to cause anything significant. So that means if we approach 2011 with the attitude of being prepared to take partial profits on good trending stocks as they come up, perhaps sometimes getting out completely, and then making sure that they've got capital to buy into the dips, then I think that's a strategy that we can pursue with some degree of confidence this year. Won't necessarily be that easy to follow it, because you'll find the media will start screaming that we're in a bubble, and every time there's a sell-off, as we saw in gold recently, there'll be any number of people who want to tell you that the bubble has burst and prices are heading a lot lower. But if you really look at the fundamentals behind what's driving those commodities, I think you'll find that the commodity prices are rising on fundamental supply and demand reasons, and not on wild speculation. Now, the Aussie indexes, the ASX 200 is really just broken out of this very significant range that was capping it at about 48.20. It rose higher for a few days and then has basically levelled out and retraced just a little bit, so we'll have a look at that chart. The Small Ordinaries Index did make a break higher earlier last week, but did close down a little bit, so we need to see that rebound and close above the 3,000 level to really confirm that the small end of the market can continue. We'll have a quick look at the US dollar and 30-year bonds, which are obviously critical in driving equity markets. The dollar's temporarily higher, but long-term interest rates are being forced towards the danger zone, and I'll talk more about that when we have a look at that chart. So here's the first one. It's the 30-year bond yield. So this is the actual interest rate itself. So you can see that I've marked in there basically a triple top, or probably even a quadruple top, which we're approaching again. That's really the danger level from a couple of perspectives. One is technically, if it breaks above there, then I think there'll be some momentum pushing it higher. But secondarily, just from a fundamental point of view, when interest rates get above 5%, and they are viewed as essentially a risk-free return, then investors are going to look at those compared to the returns from dividend-paying stocks in the US stock market and think, well, if I'm only getting 4% or so with a degree of risk in stocks, why don't I just take 5% risk-free? So that's why I think that level's pretty important. So we're still in a medium-term uptrend towards that level. But we did, tightening on there, we did pull back from that on Friday a little bit. So we'll look at the US dollar index, and as you know, we're in big picture long-term downtrend. So we've fallen substantially from basically the highs in 02, and we're now in a broad sideways range that really started in 2008. But just within the time frame that we're trading, we are heading down, I believe, certainly to this 74 level and possibly down to 71 level. Now, just looking at the Australian US dollar, you can see with Australian US dollar has been in a very major uptrend since October of 08. We did have a correction here in May where we got up to about 94, corrected back, and now we're back up just above parity. So formed a triple top. So if the Australian dollar trades and closes above about 102.5, then I think you're going to see the Australian dollar, the Australian dollar push on higher, perhaps towards the 110 mark. So the next chart I want to have a look at is the S&P 500. So this is the monthly chart. So we'll just have a little bit of a big picture look. So this peak back here is October 2007. We've had obviously the GFC and the crash that went with that, and now we retraced to basically, if we take our retracement from here, then you can see that we've got a level. So it's a little bit unclear. We've got a level of 1228 on that, which the market rallied up to here in April last year. It then pulled back to this first Fibonacci level back here at 1013, and now has pushed on, moved to a new high. So we've now moved beyond this 61.8% retracement. So that means that if this was going to be, if this run down here was part of a bigger picture bear market, then we wouldn't really have exceeded this level. We would have turned back down again, which is what I was expecting to happen. But now that we've punched through that, and as you can see, we're just continuing to close on the highs, then the next level for me is up here somewhere around about between 1400 and this level here at about 1440. So probably 1405 to 1440 is the next level. I could make a case for another Fibonacci level in here, which I don't tend to use very much, but I could make a case for around about 1360. I don't have a particularly high degree of confidence around that one because it's not a level that I use, so therefore I'm not familiar with how well it plays out. But you'd have to say at this point in time that there's every chance that the S&P could push on to this 1405 to 1440 area, which is that's another 1,000 points plus on the Dow. So that's really going to fire up global stock markets if that occurs. So just looking a little tighter on the daily chart. So you can see here we've been in a very steep sloping uptrending channel basically since August when Bernanke started talking about QE2 money printing. So we're still sitting in the middle of that trading range at the moment. You can see the 150-day moving average heading up at a pretty good clip. The 50-day is well above it. This is a big gap, and the rate of increase is pretty strong, and then the market itself is holding well above that. So whilst the market is a bit overbought in the short term, the only way you can interpret this is that it's a very, very strong uptrend, and there's no reason to suspect that it won't continue. So you can see here we had an attempted sell-off on Wednesday, but closed near the high. We had the same thing on Thursday, closed on the high. Did trade down a little bit on Friday, but again closed very much on the high of the day. So the